Good morning. This is Bloomberg Daybreak Europe. I'm Joanna Versace, and these are the stories that set your agenda. As trade talks between the world's two biggest economies roll into their second day, the U.S. president says it's fake news that he's seeking a summit with China's Xi Jinping. The euro tumbles the most in 2 months as EU leaders criticize the U.S. trade deal. The German chancellor says it will cause significant damage, with the French prime minister calling it submission. Plus, at least 5 people are killed in a shooting at an office in New York in the tower which houses the headquarters of Blackstone. Well, let's get you up to speed on how some of these markets are faring. Once again, deep in earnings season, a whole bunch of U.S. data to watch out for in the coming days, alongside those big names in tech that are reporting. Meta, Microsoft, Amazon, watch out for those. But Europe, let's start there, because yesterday we walked in thinking that it was going to be a day of green for these European bourses after the EU and the U.S. agreed to the terms of that trade deal. But that wasn't the case. By the end of the session, we saw European markets trading in the red. We had the Stocks 50 and the session down about 0.3%. The DAX index in Germany and in the session down 1%. Automakers also down anything from 3 to 4%. So a case really of buy the rumor, sell the fact. Today, though, things are looking up. European market futures up about 0.2%, both of the FTSE and the Euro Stoxx futures. S&P and the Nasdaq also pointing towards the green as we speak of, once again, all-time record highs for Wall Street. Switching over and taking a look at cross assets, because we saw a bit of a dip in the euro yesterday, the currency dropping. You can see here below 116, 115.90 is where we're at. So 1.3% is how much the euro fell yesterday as some of that tariff relief faded and investors trimmed some of their positioning. The handover this morning from Asia Pacific still negative as well. So a bit of a risk off tone prevailing in the Asian session. The pound also slipping, sitting at around 133.50 and a key technical level around here, which is constituted a point of support. Will we break through to the downside? It has been a heavy couple of weeks for the pound versus the greenback as we talk about gains in the USD. And then the Brent, you can see today is just shy of $70, that we did shoot up about 2.5% yesterday in trading after Trump threatened Russia with more sanctions if they don't come to the negotiating table and agree a truce with Ukraine within the next 10 to 12 days. So geopolitical risk being priced in to oil here. Now, President Trump says reports he is seeking a summit with China's President Xi are not correct. In a post on Truth Social, Trump said, "I may go to China, but it would only be at the invitation of Xi." The comments came as U.S. Commerce Secretary Howard Lutnick says President Trump will decide if Washington and Beijing will extend their trade truce by 90 days. Lutnick told Fox News that more deals are likely with other countries in coming days.
And the president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set. They will all be in stone, and they will be written, and we will start collecting those additional monies. Right now, we're collecting 10% from everybody in the world, and, of course, a higher rate from China. But come next week, off we go.
Let's bring in Bloomberg reporter Jonas Ekblom. Well, the talks are going on, day 2 of those discussions between U.S. representatives, China representatives in Stockholm. But it very much appears to be the case of talking for the sake of extending the deadline as opposed to agreeing on anything.
Yeah, that's correct. Like, it seems to be a pretty kicking down the can, down the road event here in Stockholm. Everything coming out from the administration right now, you got Lutnick, you got Trump, is pointing to an extension of the trade talks as they look right now, and U.S. is coming in with a very confident stride after striking deals with the EU and Japan. So.
Yeah, I mean, and also President Trump says he's not seeking a summit with China's Xi. What more do we know? Because there's been lots of speculation as to whether those two leaders will actually end up meeting in the second half of this year.
Yeah, it's like out here in Stockholm, there's very little news flow coming out of this this meeting here between Lutnick and his Chinese counterparts. But still on the agenda. Like they're still talking about export controls for fentanyl, as well as rare earth magnets for high-tech equipment, as well as discussions on whether China should continue buying Russian oil, for example. So.
Yeah, Bloomberg's Jonas Ekblom, thank you so much. And of course, for markets, it is a big driver of sentiment, given that U.S.-China has dominated so much of those tariff discussions over the course of the last few months. But it looks like we are in for a potential extension of that truce once more. So these deadlines for tariffs keep moving. Well, speaking of trade deals, the euro dropped the most in over 2 months against the dollar after initial optimism about the EU-US trade deal was replaced by worries about the economic impact of new tariffs. Let's bring in Bloomberg's executive editor for Asian markets, Paul Dobson. Paul, walk us through the price action in the euro yesterday, because the setup was so positive. If you rewind back 24 hours ago, we thought it was going to be a positive open for both the currency and the equities. That didn't quite transpire. What went down with the currency yesterday?
No, interesting, isn't it, Jemana? We did start off on the front foot for the euro at the beginning of the week, but it slowly and steadily trailed off in the opposite direction through the day. I mean, bear in mind that the euro had quite recently touched the strongest level in 3 years against the US dollar, and this is only taking back a small portion of that overall move. But it does seem like, as people considered this deal, they detected that there were some weaknesses within what the European Union had conceded in order to get it done. So yes, having some sort of a deal removes that risk of escalation, but it also sort of takes away the bargaining chips that the authorities had to try to drive better deal in some parts of the business world. And so it feels like, as a result of that, a little bit of that sort of shine that had been attached to the euro, a little bit of the optimism kind of came off, and hence we had a weakness. And on the flip side, you know, the fact that it was a decent result maybe for the US helped the dollar to strengthen, not just against the euro, but right across the board as well.
Yeah, and it wasn't just the euro that fell yesterday. If you look at, obviously, the headline level, many of these indices saw a bit of a pullback. The DAX, the German index, down 1%. But then you go a little bit deeper, autos did not have a good day at all. How do we explain that, Paul?
I think that there's two things. One, the particularities of the European deal were seen as a little bit unfavorable relative to what the market had maybe hoped that they might be able to achieve. But two, I think more generally, we've had so much excitement about all of these deals, kind of one after the other building in, particularly with Japan's last week, which was a bit of an upward surprise, and the market really storms higher again. We're at record highs, more or less, for equity markets all across the board. So it's getting harder for each successive deal that we're being struck with now to continue to fuel that momentum. It feels like we've been running on fumes for a little bit of time, and maybe the market needs to take a breather and have a look around and see, you know, kind of, all right, now we've got a lot of the details. What's this going to look like in terms of company earnings, in terms of economic growth going into the second half of the year? And you detect that there's that sort of second guessing, having a look around, feeling a little bit more cautious now, particularly with August, the holidays coming up. Maybe people think it is time to sort of scale back now and have a watch and a wait before we make any further decisions about whether the market can go into uncharted territory to the upside.
Yeah, Paul, let's not forget that we're coming off ECB last week, and the messaging from the ECB President, Christine Lagarde, is that they're quite happy with where things are for the time being. They're in wait-and-see mode. I do wonder now that we have more clarity on what this final US-EU deal is going to look like, whether growth downgrades will have to come through. And if that does happen, will the market then jump to price in, once again, a more dovish ECB?
Well, that's the thing that the policymakers have been having to grapple with all along. They don't really know what the trade deal looks like. So now at least they have that clarity on the outlook for the tariffs. Now they've got to figure out what does that map across to for growth. The ECB, like you said, seemed pretty confident and comfortable with the situation at the moment. Obviously, the US has been on pause for quite a long time at the Federal Reserve as well. And so I think that they won't rush to recalibrate thoughts now. I think the policymakers have wanted to see how does this all play out? What does it look like for the economy? What does it look like for inflation as well? You know, and since we had that kind of big booming performance in markets and better than expected growth in the first half of the year, they're probably already expecting some kind of payback to come through. So even with that, you know, the fact that the ECB is not desperate to carry on cutting interest rates just yet tells you that probably, you know, we'll wait and take our cue from the Fed and see what they do before moving any further with our own policy decisions.
Yeah, there's not even one full rate cut priced in by the end of the year. It's only 17 basis points if you look at the OIS curve. So that's interesting. Bloomberg's Paul Dobson, thank you so much. Well, let's continue the conversation and take a look at the greenback. The dollar jumped the most since early May after that trade deal was announced between the EU and US. Let's bring in Bloomberg's Valerie Teitel for more. Val, we looked at the other side of the coin, which is what people have been saying about the euro. But obviously for the USD more broadly, July's been a good month.
July has been a great month for the dollar. Many people are asking themselves whether this is just a short squeeze or is this dollar downward trend over for now. But July, best month of the year so far. The currency has rallied 1.5%, helped a lot by the session yesterday, Jumana, where we saw the Bloomberg Dollar Spot Index rise the most in 11 weeks. Now, note, this is the only month this year that the U.S. dollar has seen gains, but we are still down very much year to date, around 8% year to date. But the narrative is the more clarity we get on tariffs, the easier it is for the dollar to bounce. I think the next big question is now that we've gotten some clarity on tariffs, are we going to get more clarity on the U.S. economy? And to that, guys, we do start a busy week of U.S. data today. We have U.S. JOLTS data to kick off a big week for U.S. data and a big week especially for labor market data over in the U.S. JOLTS today, we do get ADP the day after. The big one does come on Friday with non-farm payrolls, but the market is begging for clarity. Maybe we'll get some of that this week. All of this is happening, this busy week of data and earnings, alongside the S&P 500, notching not just one record high, but now 6 straight record highs in a row for the S&P 500 index. This is something that's only happened 7 times in the last 25 years. Jumana.
Yeah, what a comeback since the lows in April, I've got to say. Bloomberg's Valerie Teitel, thank you so much for breaking it down for us. Now, a gunman has killed at least 4 people and himself in a shooting in New York City. It happened at a tower in Manhattan, which houses the global headquarters of Blackstone. Blackstone staffers say they pushed furniture against doors to barricade themselves in during the attack. The gunman was found dead on the 33rd floor of the tower.
It is unimaginable to experience a loss of this magnitude. And 3 other innocent civilians are also dead. 2 males and 1 female, and another male is seriously injured, fighting for his life in critical condition because of the violent, despicable attack.
The shooter is believed to be Shane Tamura, a 27-year-old male with a Las Vegas address. The vehicle he exited is registered in Nevada to Mr. Tamura. Inside of that vehicle, officers found a rifle case with rounds, a loaded revolver, ammunition, and magazines, a backpack, and medication prescribed to Mr. Tamura. The vehicle was searched by our bomb squad and found to be clear of any explosives. Mr. Tamura has a documented mental health history. His motives are still under investigation, and we are working to understand why he targeted this particular location.
These shocking events in Manhattan overnight. Well, later today, in terms of data, we're going to be watching out for more earnings that are going to be hitting. In about 45 minutes, we get results from Barclays, AstraZeneca, Stellantis. So we'll get more clues on how European autos are faring up with those Stellantis numbers. And then before the market opens, Boeing will be reporting as well. So that's always a key driver, obviously, in the airline manufacturing space. And then after hours, we get results out of Kering, too. So more from the luxury side of the business. Those are earnings that you can watch out for later today. And of course, you can get a roundup of the stories you need to know to get your day going. In today's edition of Daybreak, terminal subscribers can go to DayB, so DAYB, go on the terminal. And coming up, President Trump raises the pressure on Russia's Putin over Ukraine, saying he'll shorten the deadline to reach a truce. We'll have the latest developments from the U.S. leader's trip to Scotland. Plus, later in the show, I'll be joined by Bruna, Skarica, chief UK economist at Morgan Stanley, for markets conversations. Stay with us for that. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. President Trump says he will shorten his timeline for Russian leader Vladimir Putin to reach a truce with Ukraine or face potential economic penalties.
I'm going to make a new deadline of about 10 or 12 days from today. There's no reason in waiting. There's no reason in waiting. It's 50 days. I want to be generous, but we just don't see any progress being made.
Joining me now is Bloomberg's Adam Blanford. Well, this was supposed to be a 50-day window. Now Trump has reduced it to 10 to 12 days. You have to wonder whether these change in dates is arbitrary in terms of decision-making. But why has Trump issued this deadline to the Russian president? Why now?
Good morning, Jemana. As you say, a longer deadline was in the offing. I think it was just 2 weeks ago that Trump said he would issue a 50-day deadline and give Vladimir Putin 50 days to end the war in Ukraine. But, looking at that clip there, the president looked perhaps pretty exasperated. Maybe he was in the middle of a long press conference, as you know, yesterday. But he changed his timeline after just 14 days. So now he's given Vladimir Putin a 2-week ultimatum to say, stop the fighting. Really, it's because he's a man who wants to make deals. And he's found over the 6 or 7 months now that he's been in office that it's been very difficult to get Vladimir Putin to make a deal. He talked openly with Keir Starmer, the UK Prime Minister, yesterday about how he would call Vladimir Putin. He would have good calls with the Russian president, talks about how they have a good relationship. But then at the end of the calls, when the calls are finished, as he says, Putin fires missiles into a city and hits a nursing home in Kiev or another Ukrainian city. And, he sounded exasperated with this. And he's a man, as we say, who wants to get things done. He's trying to do this in other places. And he's finding it frustrating with Putin. So that's the surface level. And it seems to be he's shortening that deadline from September to now to the 1st to August again, another couple of weeks.
And also threatening Russia with the potential economic penalties as well, which is why we saw that reaction in oil yesterday, up more than 2.5%. But you mentioned his sit-down with the UK Prime Minister Keir Starmer. Russia was discussed. There was also a little bit of discussion about Gaza and the starvation there, with the US president saying that they're looking to set up food centers in Gaza. What else was discussed at that press conference? Because it went on for quite a long time.
It did. It was one of those classic Donald Trump wide-ranging press conferences. And Keir Starmer, a very different character to the U.S. president, had to sit there while Trump fielded questions and ranged widely on a whole host of topics. But of course, Gaza, the issue of the moment, was discussed, and the UK Prime Minister has been coming under pressure to toughen his stance. There's an argument to say that some of Donald Trump's language yesterday had toughened up a little bit. He certainly was outspoken on what he had seen, images from Gaza and the need to provide relief there and try to make a difference on the ground. With regards to his meeting with Keir Starmer, as you say, it was very wide-ranging. He talked to the UK Prime Minister as if he was a man who knows innately how to win elections. He has proven that in the US. He's been elected twice over with a gap in the middle. He talked to Keir Starmer about politics being pretty simple, that you need to lower taxes, lower immigration, he says at the moment, and keep crime down. That was his challenge to the UK Prime Minister as he was talking about the task of perhaps keeping Nigel Farage, the Reform UK leader, at bay when they next go to the polls in the UK. So for Trump, as he said, the one that be the most toughest and the most competent on immigration will be the one who wins the next election. So it's a slightly awkward moment there, perhaps, being given a politics lesson by the US president for Keir Starmer, but he's the diplomat as well who tries always to parlay these situations in a way that works for him too.
Yeah, most definitely. And the question is whether the UK Prime Minister escaped from this all unscathed. But it appears as though he has. So Bloomberg's Adam Blanford, thank you so much for giving us an update on Trump's visit to Scotland. And coming up, oil rallies on President Trump's renewed threat to sanction Russia if a truce can't be agreed in Ukraine. We'll discuss that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Oil spiked after President Donald Trump pushed for Russia to reach a swift truce with Ukraine or face potential economic penalties. The threat raised concerns that crude supplies from the OPEC Plus producer could be disrupted. Let's bring in Stephen Sichinski, who leads our coverage of energy in Asia. So, Stephen, maybe just walk us through the steps. Why did the oil market react in such a fashion yesterday to this announcement that President Trump is bringing forward the window for the Russian president to come to the negotiating table for a truce? Why would that lead to a spike in the oil price?
Well, I mean, before, he had until September 2nd, basically. Now he's pulling this forward. And the fears are over what Trump has threatened, and he's called secondary tariffs, basically. It's a view that if anyone is importing Russian oil or Russian energy, then he'll put some sort of restrictions on those buyers. So the fear, whether well-founded or not, is that any sort of action, if they're not able to make a ceasefire deal, which looks relatively unlikely with Ukraine, then Trump would put some restrictions on Russia that would curb the amount of oil coming from the country, the oil that can be bought, which would contract supply and lead to higher prices. That's the fear. Now let's unpack that for just one moment. Okay, what exactly does he mean by secondary tariffs? It's very unclear. What's the mechanism that he would use? Would Trump really do something that would risk higher oil prices or risk oil deliveries to certain allies or countries that they're at the negotiating table with, like China? If there were higher oil prices, that would hurt him at home. That's higher gasoline prices at the pump. He does not like that at all. So I think while oil prices did rise, and there is a fear that Trump will do something that could restrict Russian oil on the market, there is also the view that this could be a taco sort of situation. Trump always chickens out. So how exactly will this play out? It's unclear, but because there are so few details, it's hard for people in the market to take a really bullish position on this at the moment.
Yeah. Stephen, I've got about a minute, but I just want to remind viewers that on August the 3rd, OPEC Plus are holding another video conference to discuss whether to put back extra barrels to the market. Will all of this be factored in, do you think?
Yeah, I mean, traders are expecting that OPEC Plus will basically add the rest of their supply cuts back into the market in September. That's what they're going to be deciding on in this meeting. They've been doing these kind of oversized output increases, and the market is now well expecting them to just finish all of those increases by September. There's this view that OPEC Plus thinks that the market is balanced, and by adding more supply, it won't cause an oversupply. Now, analysts look at this differently. The IEA expects potentially a glut by the end of the year because of this. But let's see what OPEC Plus decides this weekend.
Yeah. Bloomberg's Stephen Sichinski, thank you so much for walking us through the oil dynamics. Well, coming up, we're going to discuss the latest on markets and UK economics with Bruna, Skarica, the chief UK economist at Morgan Stanley. That's coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Jumana Bersecci, and these are the stories that set your agenda. As trade talks between the world's two biggest economies roll into their second day, the U.S. president says it's fake news that he's seeking a summit with China's Xi Jinping. The euro tumbles the most in 2 months as EU leaders criticize the U.S. trade deal. The German chancellor says it will cause significant damage, with the French prime minister calling it submission. Plus, at least 5 people are killed in a shooting at an office in New York, in the tower which houses the headquarters of Blackstone. Bringing you up to speed on markets, European equities are pointed to open up in the green. This despite a pullback yesterday, a case of, as we spoke about, buy the rumor, sell the fact. European indices ending in the red yesterday after news of that EU-US trade deal being agreed to over the course of the weekend, with the DAX down more than 1%. But today, European futures, the Stocks 50 pointed to open up 0.2% firmer. The FTSE 100 also, as the FTSE's have broken through 9,000 to the upside, so record highs there too, also pointed to open up in the green. S&P futures, NASDAQ also leaning towards the green. Remember, we have a lot of earnings to get through today. Barclays, AstraZeneca, Stellantis, and then later in the day in the U.S., we get Boeing as well. And don't forget, later in the week, all of this U.S. data to contend with, from the inflation data, PCE, to the jobs data on Friday, and then the Fed to get through as well. Switching over in cross-asset space, also just want to draw your attention to the reaction, the price action that we had in the euro yesterday. We dropped quite a lot throughout the course of trade, down 1.3% in yesterday's trading. So pulling back from that 117 level. Today, we're sort of stabilizing around here, but it was quite a stark drop in the euro yesterday in trade as the dollar gained quite momentously as well. The pound also losing some ground versus the USD. 133.50 is where we're at. And we just spoke about oil and the fact that we saw that spike up north of 2% after the headlines around the potential truce, or President Trump asking President Putin to come to the table in the next 10 to 12 days, or else really being subject to more sanctions. So that led to some of an uptick in the price of oil. And as you can see today, the handover from Asia also pretty negative as well, down 0.8%. Well, let's pick up the conversation. So much to discuss. I'm joined now by Bruna, Skarica, the chief UK economist at Morgan Stanley. Bruna, it's really good to talk to you. I actually want to start with the trade deal, because that is really what everybody's been talking about the last couple of weeks as it pertains to EU-US. But then UK were one of the first countries around the world to get to a trade agreement with the US. Again, still thin on details. We don't know the full details on pharmaceuticals yet. You know, there's still some things that have yet to be worked out. But let me just ask you what impact you see on the UK economy on the back of this UK-US trade deal that was agreed to.
Sure. So I think when it comes to trade tensions and UK, really the impact is mostly indirect. So we have seen an increase in average U.S. import tariffs for UK products from kind of status quo ante, which is to say prior to the changes in the U.S. trade policy that were obviously introduced by the U.S. administration in April on quote-unquote Liberation Day. Now, that increase is marginally lower than, for example, what we've seen with the European Union, but it is still a pretty meaningful uplift, albeit the direct impact on the economy is really in the near term quite modest, not even 10 basis points. So really what matters for the UK economy is where really the global economy and global trade settles, because that indirect impact could potentially be a far stronger than any direct impact on the UK from the changes to the US trade policy.
Bruna, if I rewind back, say, 1 or 2 years when I used to stand outside the Bank of England and you and I would have conversations, we would talk about the perhaps stagflationary backdrop in the UK and the fact that inflation was persistently high, UK growth was really sluggish. And you fast forward to today, not much has changed. Those inflation numbers still are stubbornly high, and the backdrop is still pretty sluggish when you look at the growth data as well. How would you characterize how the UK economy looks in the coming months?
Indeed, it does seem like stagflation is just a word that refuses to go away in the UK macro context. I think in the very near term, it is very much more of the same. Just this morning, we got the BRC inflation data. It showed an uptick on the back of very elevated food inflation, so food prices picking up in the UK. And we do think that will actually come through in the CPI data in the coming months as well. Actually, I think there's a pretty good chance that the Bank of England will next week forecast a near-term peak of inflation of not too far away from 4%. On the other hand, we did see an uptick in the unemployment rate as well. And I think there's a bit more to come as far as unemployment rate goes. By the end of the year, I think it is possible that we're at a 5% handle. So I think what really matters here is the judgment of whether that increased labor market slack ultimately feeds through lower inflation over the coming years. I think the answer is yes, of course, but there is a lot of uncertainty, as I'm sure Governor Bailey and the rest of the MPC will remind us next week.
Yeah, and the recent PMI numbers also disappointing to the downside. Right now, the market is pricing in, let's call it around 2 further rate cuts by the end of the year, both in August and November. How much potential downside would you need to see in the data for it to warrant an even more aggressive rate cutting cycle, i.e. for them to opt for rate cuts at every meeting as opposed to every other meeting?
Sure. So I think if we look at the labor market alone, we would have to see really meaningful downside surprises. If you think about it, when it comes to HMRC payrolls data, which is slightly more reliable than the ONS produced labor force survey, going into the June meeting, we had a really, really very poor May figure. It was in excess of 100,000 jobs lost. Obviously, that number was revised upwards subsequently. But even that wasn't enough, for example, for that June rate cut to be delivered. So I think part of the story is just we need the totality of the labor market data to all be pointing very convincingly in one direction. And it takes a while for that evidence to build. So it does seem like the barrier for, let's say, a September cut is fairly high. And that is obviously reflected in market pricing. So I do think labor market is the key to unlocking those successive cuts. Yeah. No, go ahead. Sorry.
Yeah, I was going to say that monetary policy easing perhaps seems to be the only easing in sight, because the chancellor is under a lot of pressure now to go down the path of fiscal tightening. I mean, the gilt market is quite literally saying that under pressure to raise taxes. What do you see happening with the fiscal side of things in the coming months, and how is that likely to impact or pose a bit of a drag on the economy?
Absolutely. So I think it's important to take a step back and just remember that even from October last year and through to March this year, the 5-year fiscal plan that Chancellor presented fiscal consolidation. So a decline in deficit from around 5% last year, closer to 4.3% this year, and a bit below 4% in the coming year, and then obviously towards 3% in following years. So that 5-year consolidation plan is already Bank of England's base case, and I think what matters for the MPC is that when we get to the autumn, that consolidation plan and that planned reduction in the deficit is indeed confirmed. Obviously, for the market and for growth more broadly and for UK corporates, it matters how that consolidation is executed. Are we going to see a slowdown in real spending growth, or are we going to see tax hikes, as it seems highly likely, I would say, at this point in time, if we get slightly less revenues from the economy, if the OBR reduces their growth forecast, it is highly likely that we ultimately do see some tax hikes in the autumn. But I would say that path of fiscal consolidation is supporting our view at Morgan Stanley that the terminal rate could be lower than what the market is pricing at the moment. We think even a bit below 3%.
Interesting. Good place to leave it. Bruna, Skarica, Chief UK Economist at Morgan Stanley. Really good to chat to you. Now, the rising price of products such as tea and meat pushed UK food inflation to its highest level in 17 months. The British Retail Consortium said food bills climbed 4% in July compared with a year earlier, the fastest increase since February 2024. The data confirmed that a period of falling prices in shops has come to an end, in part due to the government's hike in the minimum wage and its efforts to raise revenue through higher payroll taxes. Well, the global trade war that President Trump unleashed in April shook investor confidence in the U.S. economy so much that it sparked a stampede out of the dollar. But much of that money has washed up in developing economies. Joining me for more is Bloomberg Emerging Markets reporter Selçuk Gökalp. Good to have you on the show. Selçuk, so maybe just walk us through this decade of underperformance for emerging market assets. But we've finally seen some outperformance this year, especially versus the U.S. and other developed economies. Why has that been the case?
Yes, it has been quite a good year for emerging market assets in general. We have seen on the stock markets, on average, 17% gain, and at the same time, in the bond markets, more than 10% gains. I mean, one critical thing is the weaker dollar actually supported emerging market assets, and at the same time, investors are looking for diversity in their portfolios. They are diversifying away from U.S. assets after several years of spectacular performance. Valuations are quite rich in the U.S. stock market, but they are a lot more attractive in alternative markets, including emerging markets.
Yeah, when we talk about emerging markets, it's such a broad basket. I wonder if you could whittle it down a little bit more and provide us details on which geographies have been of particular interest this year.
Yes, of course. I mean, we have seen, for example, 40% gains on average in Eastern European markets. Poland, Slovenia, Romania, all these markets benefited from flows into European markets, and at the same time increased domestic spending, increased defense spending, and at the same time in Latin America we also see great gains, and also China. I can say that easily. It's been a broad-based rally benefiting many markets rather than just one market lifting others.
The dollar has started to give back some of its underperformance. In the month of July, it's rallied 1.5%. I wonder whether that's going to act as a potential headwind into the second half of the year, i.e., is this emerging markets outperformance sustainable, or are we likely to see advanced economies soar back?
It's a huge risk factor, is correct, because when the dollar strengthens, it's a negative thing for emerging markets. And when it weakens, it really supports risk sentiment and it supports EM assets. I mean, one thing is Federal Reserve policy, monetary policy from the U.S. If Federal Reserve cuts interest rates, it usually traditionally backs risk sentiment, and it backs emerging market flows. And another factor we can watch is trade agreements. Less uncertainty in the market also supports risk sentiment, and it supports EM assets. If we see more trade deals with the U.S., probably we can see that the dollar weakens again, and then probably emerging market assets continue their gains.
Bloomberg Emerging Markets reporter Selçuk Gökalp, a great piece. And for anyone who wants more information, you can go to the terminal. It's today's big take, so NI Big Take on the terminal if you want more information. A gunman has killed at least 4 people and himself in a shooting in New York City. It happened at a tower in Manhattan, which houses the global headquarters of Blackstone. Bloomberg's Shakil Omari was at the location of the shooting and explains what he witnessed.
A very chaotic scene happening here on Park Avenue. This all unfolded around 6 Monday evening, where I saw a lot of police officers running in different directions, helicopters swarming the area for at least 3 hours. Now on the ground, fire and EMS crews flooded the scene with a lot of bystanders asking a lot of questions. Now there were police in tactical gear entering the building, and there were employees exiting the building with their hands above their heads in shock. Employees who were on the 32nd floor of the building say they pushed furniture in front of the doors to barricade themselves from the attack. Now, Blackstone is one of the largest asset management companies and employed almost 5,000 people at the end of 2024. Now, this is an ongoing investigation with so many questions remain as to what led up to this shooting. For now, in Midtown Manhattan, Shakil Omari, Bloomberg News.
We will bring you updates on the situation throughout the day. And coming up, a host of European earnings today with Barclays, AstraZeneca, and Stellantis reporting shortly. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making news. Shareholders in Wise have approved a proposal to shift its primary listing out of London, a move that will also allow the fintech's chief executive to keep his so-called golden shares for many more years. Wise has argued that moving its listing to the U.S. will ultimately open up its shares to legions of retail and institutional investors, giving it more liquidity and presumably boosting its valuation. Oil giant Vitol delivered a record $10.6 billion to its executives and senior staff last year through share buybacks, the biggest payouts in the industry's history. The energy trader's profit for 2024 was more than its four biggest rivals combined. Vitol has now paid over $31 billion to its partners in the past decade, even as profits begin to cool. Essilor-Luxottica has posted better than expected revenue in the second quarter, showing strong gains in Europe as it pressed ahead with its smart glasses initiative. Revenue at the world's biggest eyewear maker increased 7.3% at constant exchange rates, ahead of the 5.9% expected on average by analysts. Sales of Ray-Ban Meta smart glasses more than tripled in the first half. And it is a busy day ahead with earnings from Barclays, Stellantis, and AstraZeneca, all reporting in about 12 minutes' time at 7 o'clock in London. Let's bring in Bloomberg's Khoi Millet. Maybe let's just start with the bank, with Barclays, and what we can expect there. Barclays is always interesting to watch because they've got, obviously, the investment banking arm, but then we could get some strong signals about the strength of the UK economy with their UK retail banking arm as well.
Yeah, absolutely. So I think for Barclays, we kind of got a taste of what to expect when we had BNP Paribas and Deutsche Bank last week. And what it shows is really that those banks with those strong investment banking operations, as you mentioned, are doing really well because of that boost from the volatility in the second quarter. So Barclays will expect fixed income trading to do particularly well, but equities trading also looks in pretty good shape. And as you mentioned, it could also do quite well in that kind of UK retail banking arm, especially with quite resilient net interest income. And that's kind of doing better than other banks in this earnings season that have reported that kind of slowdown in their interest income. But Barclays is benefiting from structural hedges, and that's kind of helping it shield itself against the impact of those low interest rates. The only kind of negative spot that we may expect is that some analysts are also looking at potentially higher provisions for loan losses in the US consumer bank. But otherwise, across the board, it looks pretty good. Net interest income and investment banking looking pretty good for Barclays when it reports in about 10 minutes.
Yeah, okay, we'll find out soon. What about Stellantis, automakers, German automakers, European automakers not having a good time lately? What are we expecting there?
Well, for Stellantis, we analysts and investors, obviously, fresh in their memory is the earnings pre-release that we got last week, which has obviously dented expectations going into this release. For this particular set of earnings, the full set of earnings, analysts are really looking for, the cash burn, cost management. They're concerned about those things, and as a result, they expect kind of a lower margin. In terms of shareholder returns, they also said that the dividend could be zero and that buybacks could be off the table, which is obviously not really positive for investors. Going forward, some say that there's kind of no positive catalysts happening very soon. Others see kind of some more positive drivers like new product launches, for example, and are expecting the company to kind of signal a better second half than the first half. And of course, helping sentiment, if not the fundamentals yet, is of course the new US-EU trade deal.
Yeah, well, speaking of tariffs, we also get an update from AstraZeneca this morning. President Trump saying that there should be some clarity soon on what's going to happen with pharmaceutical tariffs. How's that likely to show up?
Yeah, so for AstraZeneca, there's two things to look out for in terms of the U.S. So, of course, as you mentioned, those tariffs and kind of AstraZeneca has announced that it was going to invest $50 billion by 2030 in the U.S. to kind of mitigate that tariff impact. So we'll see what they say about that. But then there's also been reports about AstraZeneca potentially wanting to move its listing to the U.S. So we'll be looking out for any commentary around that in the analyst call as well to see if there's kind of any truth to that and what the timeline would be in that regard. In terms of the earnings themselves, we're expecting quite a good quarter. Some analysts are even speaking of a potential guidance raise, and any kind of negativity would be coming from maybe higher than expected research and development spending, which might kind of put a little bit of pressure on margin, and changes of coverage with Medicare, which also would put pressure on margins. But overall, we're expecting quite a resilient quarter when it reports this morning.
Yeah, and maybe a couple of sweeteners in the U.S. Bloomberg's Chloe Melly, thank you so much for giving us an overview of what to expect in just a couple of minutes' time. These earnings are hitting. And on a programming note, we've got an exclusive interview with the Barclays CEO that is coming up in the opening trade at 7:10 a.m. London time. Well, there's plenty more coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So let's tie together some of the big themes we were discussing on today's show. The fact that the euro pulled back yesterday, EM assets have been doing well, and namely because the dollar has started to recover some of the lost ground. Take a look at how the greenback has performed the first few months of this year. Negative, 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 negative. July, though, we are on track for a positive month, up 1.5%. So still tracking negative for the whole year, but some of those losses are starting to be recuperated. So we'll see how this does in the coming months, because that could have knock-on effects for global markets, specifically emerging markets, as we were talking about. Switching over, the other chart I wanted to show you, we've been talking about the S&P and NASDAQ making record high after record high after record high. But again, here, take a look at this. S&P hasn't posted a 1% up or down day in over a month. So that tells you that we're creeping higher every day, but perhaps some of that momentum is beginning to fade. So people who tend to look at technicals in global markets will watch this very closely for clues that perhaps the rally is losing a bit of steam. And the fact that we are losing some intraday volatility suggests that that is the case. And then finally, later today, we're going to get a big signal for the U.S. jobs market. The big one, obviously, being non-farm payrolls on Friday. But today we get JOLTS data. That's always watched very closely to look at the job openings per unemployed worker and whether or not there are more jobs available on the market. A sign, obviously, of a healthier economy versus sub-1, less healthy. So something to bear in mind as we head into that 3 p.m. London JOLTS data coming up in the U.S. And, of course, so much more data in the U.S. the next few days with the PCE data, with the Fed meeting, and, of course, the job data on Friday. Bloomberg Terminal users can access these charts and others used throughout the show at GTV Go on the Bloomberg Terminal. And programming notes, don't miss our interviews with the CEOs of Barclays and Philips. Those are coming up in the next show in opening trade. So all of that to watch out for. It is obviously going to be a very big day in terms of European earnings. We have AstraZeneca, Barclays, Stellantis earnings all hitting in a couple of minutes, as we were just talking about, in addition to further reaction to the trade deal news that has been emerging. U.S.-EU, bit of a disappointment trade today. Does that turn around? Will we see some love for the autos and other sectors impacted by those trade deals? A question for today's trade. Well, the opening trade is coming up next. This is Bloomberg.